Well, 2022 has ended. It's one for the record books. And some of the records are definitely interesting. Let's just say Las Vegas real estate did do better than the Raiders this past season. So I am Justin Miller. I am one of the co-founders and the principal at the Chong Miller Group. And at the Chong Miller Group, we help people buy and sell homes and help people maintain, grow, and protect their wealth. Let's take a look at what happened during December of 2022, but also at the entire year of 2022, since we now have been able to close the books on that challenging year. As you know, every month I produce a market update for single family housing. That's resale, residential real estate in the Las Vegas Valley. I also do a companion video every month for resale residential condos and townhomes in the Las Vegas Valley. This video is about single family. I recommend that if you're interested in the market more generally, or you're thinking about how the market may be evolving over time, you check out both videos. I split them into the single family and the condo and townhome segments or separate videos because those populations of housing types are distinct. They may move in different manners based on underlying issues in the economy and the way in which the housing market itself further develops over time in the Las Vegas Valley. Now, before I get into the specific data for December of 2022, let me talk just briefly about another issue. A simple issue, but just so you know. In the lower corner, you'll notice the logo for my brokerage, Keller Williams, the marketplace. Now, for those of you who've been very observant over time, you'll notice this is actually a slight change. The brokerage has changed its name actually as of the day after I'm recording this video. We used to be Keller Williams Marketplace 1. This does not represent a move on the part of Chong Miller Group from one place to another. Rather, this represents a reorganization and some consolidation in the real estate business. And so I just want to mention this to you real briefly so you have an understanding of what it is and how it may impact you. On the one hand, this will be completely seamless for any of my clients and for those who may do business with us in the future. But this has resulted from a merger that's taken place between 4 separate Keller Williams offices here in the Las Vegas Valley. Over this past year, and we'll discuss it as we get into the numbers, there's been a significant drop-off in the level of activity, real estate activity here in the Valley. Just like real estate agents, brokers make their living, pay their bills based on revenue they're able to achieve from helping people buy and sell homes. And so as total transaction volume has come down in the Las Vegas Valley, as well as actually across the entire country. What that means is there's been pressure put on individual agents and on their brokerages that has reduced the amount of money they have to be able to pay various bills. Some brokerages have actually been forced to close. Others are teetering on the brink of failure. Keller Williams, on the other hand, our combined brokerages have actually been doing really quite well and decided to take advantage of this opportunity to consolidate 4 separate Keller Williams offices here in the Valley. Now, because of that, Keller Williams Marketplace now is the 3rd largest brokerage in the Valley. It's actually the 3rd largest brokerage in all of Las Vegas. So that means we've got behind us hundreds, literally multiple hundreds of people who can help us move properties more quickly, find buyers or find sellers more accurately and appropriately in the tightly constrained market. This also reduces some of the expenditures that the brokerage needs to maintain. Now, what is a brokerage and how does that relate to me? Well, Jason Chong and Justin Miller, myself, we founded Chong Miller Group, and we practice as a team to help our clients. But in Nevada, in order to professionally practice real estate legally, one must put their license with a broker. And so my license and Jason's license, we have placed our licenses with Keller Williams. What does the broker do? The broker provides some back-end support, so some of the paperwork processing. They provide record keeping required by the state. They provide some level of signage required by the state. There's a bunch of technical issues. They also relieve me from having to deal with some of those technical issues so that I can concentrate more completely on the needs of our clients. As well, the brokerage may provide training, and Keller Williams provides lots of training courses. They may provide certain other benefits. Some brokerages do, and some do not provide those other kinds of benefits. So when Jason and I had been searching a couple years ago for a brokerage to join, after having tried out two, we decided to put our licenses with Keller Williams, and we've been very happy with doing that. But so the brokerage has now changed its name, and in doing so has become approximately 3.5 times larger than what it had before. And so it's now Keller Williams, the marketplace, and hence we've changed our logo. All right, having said that, let's get into the numbers for resale single family residential in the Las Vegas Valley and what happened in December of 2022 as well as the entire year 2022. Now, as I record this, it's January 8th, but the data were pulled on January 7th. I like to pull the data every month on the 7th because that way I know the data is more stable, because almost all of the data has been accurately updated from the month prior. If I pull data earlier, I'm going to have a lot more variation than what's actually observed in the corrected data set. And so I don't really like to pull the data earlier. If I pull it later, there's not going to be a whole lot of variation from what I can present from data pulled on the 7th, but it delays getting the information out to you. And so I like to pull the data on the 7th and then produce the videos on either the 7th or the 8th or the 9th, depending on what's going on around me and what the time availability is to be able to get these out. I usually publish the single family first and then the multifamily that same day or the day after. So if you're looking for the condo and townhome video, please stand by. That'll be produced hopefully later on today and should get into the YouTube universe within the next day or so. Now, because I pulled the data on January 7th, what that means, remember, is we have the complete data set for December. So we know all of the transactions that took place in the month of December. And so the data set is always pulled on the 7th by me, on the 7th of the subsequent month, and that gives rise to the market update video. So this is the January update, but what we're looking at is December 2022 data. All right, having gotten that clarification statement out of the way, let's go ahead and dive right into the numbers. Now, first number I've been looking at every month is price. How well did the market hold up during the course of December of 2022 for single family resale residential real estate in the Las Vegas Valley? And I've been looking at price first because a lot of people this past year, and in fact it's already started this year, have been talking about how the market's going to completely collapse, everything's going to zero, and if it's not going to zero, it's at least going down by 50%. Well, now we know. Now we can actually go and look at real data, not just for part of the year, not just my forecasting for what I think was going to happen, but we can see who was accurate and who was inaccurate. And hint, like always, I'm providing you not just correct data, but I'm providing you correct information about what the data says should be happening into the future. And so we did not crash. We did not come close to crashing here in the Las Vegas Valley. Pricing, median sale price in December of 2022, $415,000. Now that is down. It is down $10,000 from November, from $425,000. That is down 2.4%. It is also down year over year. We came down from $480,000 at the end of May. We came down $65,000, which sounds like a lot, But we came down from 425 at the beginning of 2022, which means we ended 2022 down $10,000, down 2.4%. Now, that's rather interesting. In a year where the market was supposed to be collapsing, down at least 50%, we're down 2.4%. If you had bought on January 1st of 2022, the price on your property, assuming you bought exactly at the median, had exactly the average home, the price would be down $10,000 over the course of the entirety of 2022. Now, we went on a bit of a roller coaster ride to get there. The median price had gone from 425 all the way up to 480 and back down to 415. But realistically, you would be down $10,000. Now, what does that amount to? About 2/3 of the market, a little bit more, buy properties with a mortgage. And most mortgages are conforming mortgages. They've got about a 20% down payment. So if you'd bought at the beginning of the year on a $425,000 property, you would be $85,000 of down payment that you put into that property. So you would still have, now that we're down $10,000, you'd have $75,000 of equity still remaining in your house, plus whatever little additional bit that you gained, maybe about $1,000 in the payments that you've been making throughout the year, paying down the principal on that loan. So you would be down about $9,000 to about $76,000 in equity from the 85 you initially paid in. Not bad at all, actually. So clearly not a fantastic year. And as we look at a chart for how pricing has held up over the prior 10 years, certainly we see that we've corrected. We've corrected off that peak that came in May. Year over year, we're down 2.4%. So what happened in the first half of the year? We continued on the rapid sales pace that we had seen develop over the last part of 2020, after the economy reopened from the pandemic forced close down. We saw throughout 2021. We actually saw that happening through the first 5 months of 2022 as well. And now we've reset, we've corrected and come back down. We're a little below trend now. If we look at the long-term trend says that actually we should be at about 420, 422 right now on prices. So not exactly a big problem, but that's where we are. So I had suggested that we were going to end the year up. Certainly the first half of the year looked that way. We did not end the year up. We were off 2.4%, which means I was a little bit optimistic with regard to how the interest rate environment was going to change. And if you go back and look at my forecast video for 2022, I had commented that interest rates were likely to get up to the high 5s, maybe 6%, but I didn't see anything going higher than that. Well, what happened was interest rates actually bumped up to about 7.5%. They've come back down because mortgage interest rates got way ahead of where the bond market suggests rates should actually be. The mortgage bond market, even now in the first week of January, suggests that mortgage rates for 30-year fixed rate loans should actually be just below 6%. And they're not just below 6%. Even now they're at 6.48% as of the end of December of 2022. So interest rates, mortgage interest rates, are actually too high relative to market conditions. And I don't mean how the economy is growing, but rather I mean in reference to the 10-year Treasury, which is the base rate off of which most mortgages get set. So the mortgage-backed securities market has been not just hyper vigilant, but has been hyper aggressive this year in responding to every element of news, this year meaning 2022, every element of news, and therefore they've responded too aggressively to the rate increases the Fed has put in place on the federal funds rate, on the policy rate. I believe we still are going to see mortgage interest rates correcting back to appropriate trend. And so mortgage interest rates should be coming down to a little below 6%. probably as we go through the month of January. Now, having said that, I do want to caution you, the Fed is still talking extremely aggressively about attacking inflation. And by the way, inflation is coming down. The monthly data on inflation is showing inflation trends are downward now. They're still elevated, but they're coming down, they're moderating. But the Fed has indicated they're going to raise rates, the policy rate, the federal funds rate, the only rate they control, again in February, likely again in March, probably 50 basis points at each of those increases. So from 4.5%, we could get up to 5.5% on the Fed funds rate. That means that mortgage rates over the next few months, while they'll trend probably toward what's the appropriate gap to the 10-year Treasury, from an elevated gap right now, they'll probably still also be forced a little higher as the 10-year Treasury rates are likely to go a bit higher as we go through the first quarter and partway through, some portion of the way through the second quarter of 2023. And that will continue to exert pressure on pricing. Now, let's look at price per foot as well. We know we're down 2.4% at the median sale price. And by the way, those are sale prices. Those are not listing prices. Those are sale prices for the median house that's sold. The price per foot is the median price per foot for the houses that did sell, and that dropped from $235 to $230 per foot, or down 2.1% month over month. So from November 2022 to December 2022, it dropped 0.4%, 0.4% from 231 to 230 during the course of the year. So what that shows is price per foot has been coming down at about the same rate that that median sale price has been coming down over the past several months, but we had a little bit stronger market in the higher end, the upper end, the above median price portion of the market in the first half of the year than we did in the second half. And so even though we've been coming down at about the same rate, we're still a little bit higher, down 0.4% instead of 2.4% at the median sale price. And it's actually because the first couple months of the year, the price per foot was jumping at a little bit more rapid rate. So generally speaking, while the upper end of the market had been going up a little more strongly early in 2022, it's been coming down very much in line in the second half of 2022 with the broader market. And so that's kind of interesting. All portions of the single family housing market in the Las Vegas Valley have been impacted pretty comparably in the second half of the year. Okay, now what about number of units sold? And this is a really interesting thing. In the Las Vegas market, I've commented numerous times, volatility is actually not measured in price, as we saw on that price chart. Pricing goes up according to trend, and there's fluctuations around the trend. As to number of units sold, or number of units going into contract, or number of units listed, or number of units sitting in inventory, those numbers do not have very much of a pronounced trend. There's a very slight growth across those numbers over time, associated almost specifically with population growth, but that's it. And so what we see is tremendous volatility around these numeric count items, pieces of data. Now, when people talk about volatility in the Las Vegas housing market, it's not on price. If they think it's on price, they're misstating it. It's actually on these count numbers, and there's extreme volatility. So how do we actually look for December of 2022? 1,334 houses, single family resale residential, sold in the Las Vegas Valley in December 2022. Now, that's a small number. That's a small number. That's actually down from what we saw in November. Now, we can sort of expect that because there's a seasonal issue here, which I'll talk about in a second, but we're down from 1,367, or down 2.4% from the number that sold in November. We're down 57.2% from the 3,114 that sold in December of 2021. Now remember, 2021 was a really strong year, but we are way down. We're so far down that the number of units, number of single family homes sold in the Las Vegas Valley in December was the lowest since February 2008. There's 11 months during the 2007 to 2008 timeframe where sales were actually below what we're at right now at the end of 2022. This is shockingly small volume, and when you think about the valley has grown over 27% in the intervening 14 years between 2008 and 2022. These numbers, if you adjusted per capita for the valley, these numbers are the lowest that we've seen since the mid-90s, when the Las Vegas Valley was a very, very different place, right? Before Bellagio opened, before Paris opened, at about the time that Luxor and Mandalay Bay were initially opening. So a really different kind of place that existed here in the valley at that time. So these numbers are really low. And this is why we're starting to see some brokerages come under significant pressure on their business models and failing, and why Keller Williams decided to go ahead and consolidate 4 offices is because of this. So when a real estate agent represents you and you make a purchase or you make a sale, the real estate agent is getting some commission on that. And for round numbers, let's just say it's 3%. And it may be more, it may be less, but let's just say for round numbers, for the ease of calculation. Well, the brokerage is going to take an override, and different brokerages refer to that override by different terms. But the brokerage is going to take some portion of what that agent made in order to pay for the broker, all the broker support staff, all the broker services that are provided. And that is usually about 50%. It may be as little as a third. So a third of 3% would be 1% of the transaction. A half would be 1.5% of the transaction. Some brokerages actually charge even more than that. So that leaves the individual agent with 1.5 to 2% of the transaction. That individual agent has to pay their LVR fees, their professional association fees. They have to pay their taxes. They have to pay for whatever all their expenses are. And that leaves them with some money in their pocket to be able to pay for their own rent and food and etc. Well, over the second half of 2022, if we took the volume of transactions across all of those months, all of those sales, that number comes out to about half the total agents that exist in the membership of the Las Vegas Realtors Association. Now, every transaction has 2 sides, the buy side and the sell side. So there's two sides per transaction. And so if we add those up, what we actually see is in the second half of 2022, the average real estate agent was able to make 1 transaction. They were able to make 2 transactions during the entire year. So a lot of real estate agents are likely to be exiting the environment because they cannot afford to live with that level of income, or they're taking on second jobs, third jobs, which is highly reducing the effectiveness that they can achieve in the environment. Because if you're not doing real estate full time, you don't see what's going on in the market to be able to help buyers find the right house, because the house that they wanted may come on and disappear before one notices. You're not able to help sellers well because you're not able to get out there doing all of the appropriate marketing activities because you're consumed with trying simply to survive. Well, the same thing's happening to brokerages. And so brokerages are having to cut back. Just like a lot of agents will be leaving the market, a lot of brokerages will be leaving the market. And so that's kind of an interesting thing that's taking place right now. And it's not just in the Las Vegas Valley. Total number of agents in the National Association of Realtors had achieved a peak at the beginning of 2022. And I anticipate that those numbers now that dues are being required to be paid for the year, will be starting to drop off considerably as well. So if you've got an agent you're working with, or somebody who's part-time, or somebody who's having really big problems and needing to potentially exit the environment, you should be looking for agents who can actually step in and help you with your real estate activities, because there are people who are being successful and who are doing this on an ongoing basis and able to make a living. And there are some brokerages who are as well. And so Keller Williams, the marketplace, is one of those very successful brokerages. One other note on this regard, just so you have an idea of how volume has changed over time. Sales volume for 2021, which had been a record year for volume in the Las Vegas Valley. So we're not just coming off, a normal year. We're coming off a record year of 2021, going into a really incredibly low year for 2022. In 2021, total single family resale residential transactions, number of houses sold, 37,762. That number has fallen by over 11,000. In 2022, that number had dropped to 26,419. That's a drop of 30.0% from one year to the next. So from a record strong year in 2021 to a very weak year in 2022, down 30.0%. That's where we see real volatility, is in these count variables, these numbers of transactions, as well as inventory, new on market, pending home sales, things like that. So when people talk to you about volatility, keep in mind that's, even if they're not being knowledgeable in the comments they're making, that's where we actually see volatility in Las Vegas. And we do. Las Vegas is actually really volatile. We get hit with increases and decreases in sales volume at a more rapid pace than most of the real estate environments around the country. It's kind of surprising. When we had the government shut down for a month in 2018, we saw a significant drop off over a 1 month period of time in transactions. And so it's interesting. We can correlate those directly to what things that are going on in the environment, those increases and decreases in volume. But we don't see changes in pricing taking place in that same manner. All right. So that's what went on in December of 2022. Now let's look at some other data about December 2022 that gives us some real insight into what may start to happen in especially January 2023, but also looking forward across the longer period of time of 2023. So the first item is pending home sales. That's contracts written on a resale. So buyer and seller get into a contract. Buyer wants to buy the house, makes an offer, the offer is accepted, and buyer and seller sign. They're sitting there waiting to get through the escrow process. And the escrow process includes your inspections and your appraisals. It includes title searches to make sure seller can actually sell the house, to make sure buyer doesn't have some problem that's going to prevent the buyer from buying the house. There's the funding with the bank. So there's a wide variety of issues that have to take place while you go through that escrow period, that pending contract. That usually takes about 30 days. Sometimes, if it's a cash transaction, it can be a little shorter. If it's a transaction of whatever type, it can be longer, but usually about 30 days, sometimes maybe 45 days. If you get out of that time window, then you're in an unusual transaction. You're taking longer or less time. So pending home sales, contracts written, 1,318 in December of 2022. Now that's down, it's down a little bit from November, down from the 1,329 or 0.8% that were written in November of 2022. It is down 45.9% from the 2,438 that were written in December of 2021. Now, a couple points about this. One, seasonally, pending home sales is lowest in December. Every year, if you look at a chart, you see this great big dip that takes place in December. It's because fewer people are looking for properties between Thanksgiving and New Year's. And so fewer people are actually putting something into contract. And we start to see that pick up seasonally in January. But this year, pending home sales looked a little bit stronger in November. And I thought we were going to see perhaps a slight pickup in closed sales in December. We actually saw a slight tick down. We saw a 2.4% decrease in actual closings. Now, just like pendings are usually lowest in December, actual closings are usually lowest in January, because that follows on from people going into contract in December, closing 30 days later, so that we got this very low pending number suggests that, like we would normally see, January is likely to be a very slow month in terms of closing volume as well. So not everything that goes pending will close in the month following. Some things closed a little quicker, some things take a little longer, and some things drop out and go back on market, which we'll talk about in a minute. But it's a good indicator of what we'd be looking at for closed volume in the month of January. So 1318. Now, this is way below normal. This is, as I mentioned, the it's actually not equal to, it is the lowest number of pending contracts since December 2007. This is way below the pandemic low that we saw in pending contracts in the April and May timeframe in 2020, right, when the economy was shut down and people could not do anything. This number is below that. So this is a very, very weak number, and it's looking forward into January, suggesting January sales are going to continue this potentially downtrend to be very weak. And then we'll start to maybe see some recovery as we do under normal seasonal patterns in February, March, etc. We don't have enough data to indicate that yet. Now, next piece of data, the inventory. 6,360 single-family homes were listed for resale and available sitting in inventory at the end of December of 2022. That number is down 21.8% from the 8,133 that were listed for sale that were sitting in inventory at the end of November of 2022. So very strong downtrend in place on inventory. And of course, it's mostly existing inventory that can be sold, right? There's occasionally a transaction that takes place where a house was never listed and a buyer comes along and says, hey, I want your house, or where a house gets listed and a day later it gets picked up for purchase, and so it doesn't really show in the inventory numbers. So in 2021, we were seeing really low levels of inventory, but we were also seeing record transaction volume. Nonetheless, the really low levels of inventory put significant pricing pressure into the market, pricing pressure that pushes prices higher because supply is really constrained. So how constrained are we, relatively speaking? So I will say inventory at the end of 2021, we're actually up 75.6% from the 3,622 that were in inventory at that time. So we are up, but we're also about 40% below normal inventory for this time of year. So that inventory is sitting here at 6,360. The number is abstract in and of itself. It's about 60% of normal inventory. Right? Last year, 2021, we had record low inventory in the modern market in Las Vegas, and so that we're up from that. That's great, but we're still sitting here with dramatic problems in inventory. Let me point this to you in one other way, and that is months of supply. This number sometimes gets reported. It's a calculated number. It may be interesting to you, but it shows something really impactful here, and that is we had at the end of November 3.7 months worth of supply, houses sitting in inventory relative to the number of sales. And sales were coming down, right? But inventory was falling even more quickly. It was at 3.7%. It's at 3.0% is how we ended December, how we ended 2022. A normally functioning market, a balanced market between buyers and sellers, 5 to 6 months worth of inventory. We're at 3.0 months. In May, we had gotten up to 3.9 months worth of inventory, right? And we started to see pricing pressure come back the other way, but that was also associated with dramatically increasing interest rates. So we were still not really a balanced market. We've never entered a buyer's market here. We've seen decreasing sales because interest rates have been driving this market, and we saw increasing inventory because things were not selling. Well, now what we're seeing is actually decreasing sales because we still have high interest rates and they're still effectively going higher. And we're seeing inventory, sellers, leaving this market even more quickly than buyers, such that we've pulled inventory over the course of December down by 0.7 month, by 3 weeks worth of inventory has just left this market. It's not because things are selling, it's because sellers are leaving the market. Now, another way we can look at this is actually by looking just at new listings. These are newly listed into the market resale single family homes. This number in December of 2022, at the end of the month, was 1,603. That's down 20.6% from the 2020 at the end of November, or that we saw during the month of November. It's down 28.3% from the 2,337 that we saw during December of 2021. This is the lowest number of new listings coming into the market since December of 2007. Right at the very bottom of the financial crisis. So this number is astoundingly weak. It means that sellers are leaving. We're seeing it in the inventory number, and new sellers are not coming in. They're coming in at a very low rate, which is going to mean that we have continued decreases in inventory, and smaller levels of inventory will be putting upward pricing pressure on the market. Now, of course, to get a sale, you need not just a seller, you need a buyer. And so I've been saying for a couple months, I said in my forecast video, the real question that animates what's going to happen in 2023 is who returns to this market first, buyers or sellers? If buyers come back, we're primed to be looking at a duplicate of the second half of 2020, when after the economy reopened from the forced pandemic shutdown, we had buyers coming back into the market more quickly than sellers, and those buyers were meeting too little inventory. They were having to buy quickly. They were buying at higher prices. They were bidding up prices, and we saw significant upward pricing pressure in the back half of 2020. I rather think that could happen. Now, I will tell you, there's a lot of experienced real estate agents out there who are seeing this same data, or a version of the same data, because they may not be able to pull the different parts exactly right, because the LVR releases the data in a manner which is actually not correct. But they're looking at generally the same market conditions and generally the same data. And they're saying, well, every year we see inventory come down, we see new listings come down in fall. We hit the bottom for inventory in December. We hit the bottom for new contracts pending sales in December. We hit the bottom for closed sales in January, and people start coming back into the market because that's the seasonal pattern. And there is a seasonal pattern, and it's a very strong seasonal pattern. And I don't mean to dismiss that. But what we're seeing now is not the development of the normal seasonal pattern with slowdowns in inventory, new listings, or pending sales. We are seeing something much deeper than that. And that's why we have numbers that we have to compare all the way back to 2008, February, December 2007, right? Very, very low numbers, which means sellers have been pulling out of this market much more rapidly and much more aggressively than what they do in a normal seasonal pattern. And I do not think they're going to be coming back with that same level of aggression. I don't think they're going to be coming back with normal levels of assertiveness in the first quarter and probably the second quarter of 2023. So I think we're going to see increasing levels of decreases in inventory with too few new listings coming into this market. Why? Some people who had their homes listed for sale ended up pulling out of the market and renting out their properties. And so they're not going to come back in. Other people who pulled off may have decided, you know what, I've got a great interest rate. I don't need to sell my house because I'm locked in at 2 3/4 or 3% on my interest rate. Anything I do with my proceeds, I'm going to have a higher interest rate. So some sellers probably have conditioned themselves now to, no, I'm staying in my house for a longer period of time. So they're not going to be coming back into the market. So we'll see exactly how this develops. But as I said in my 2023 market forecast that I published in December, and you can go back and watch that if you've not, I'm consistent in my belief that we're actually going to see further deterioration in inventory levels. I'm consistent in my belief that I think we're actually going to see, now that the Fed has slowed its rate of increases, buyers returning into this market, confronting too little inventory, too little supply, and that's going to start to turn prices around. Now, I'm not saying that's happening today, the first weekend in January. I don't think that's accurate. I think that probably prices are going to go down a little bit in January. They may go down a little bit in February. The way the mortgage-backed securities market responds to this next increase in the Fed funds rate in February will sort of determine where we get the bottom and the trajectory off the bottom in sales volume and in pricing. I suspect that the market reaction will actually be pretty good to the February Fed funds rate increase after the FOMC meeting, but we'll see. It may be delayed a month from that. By quarter two, so by April, we're going to be seeing the stabilization, and we'll be seeing the putting in of the bottom of the market. And in quarters 3 and 4, the back half of 2023, we're going to be seeing significant increases in sales and significant increases in pricing, especially if buyers actually do come back into this market more quickly than sellers, which is what I believe is going to actually happen. Now, two other pieces of data that I want to talk about. One I've been presenting every month for the past year, and that is the back on market statistic. Remember, not everything that becomes a pending sale actually closes. Some things will go into contract and drop back out. And that happens for a variety of reasons, but generally through much of 2022, we started to see that back on market number moderating slightly, but it's still really elevated. Normal is between 10 and 15% of contracts that get written fall out. Well, the number for December of 2022, 605 single family resales that had gone into contract dropped out. That's 31.2% of all contracts. We're sitting at double the number of contracts that actually failed to close relative to a more normal environment. This is down very slightly from 31.5% in November, but it is still a very elevated number. It is twice what we should be seeing for back on market. The other thing that I want to comment on real quickly is affordability. And those of you who've been watching my videos for a while know that I find the affordability conversation to be somewhat problematic. I find it to be problematic because it's based on a set of suppositions, a set of assumptions that are themselves are probably partly inaccurate and highly morphable. There's a bunch of different things that can move to change affordability. But let's still look at the data. As I pointed out, the market peak that happened just prior to the financial crisis, $314,700 on an inflation-adjusted basis to 2022 dollars. That's $448,800. Now we're down from that, right? We're at $415,000, so we're down $33,000 from that prior peak. But most people do not buy houses cash. 2/3 or a little more of the market buy with a mortgage. And so we have to take mortgages into account when we talk about affordability. So at the average interest rate that existed in June of 2006, 6.75%, if we took a 90% loan-to-value loan on the median house, that provided us with a monthly mortgage payment of $2,595. So we've been below that all year in 2022, even though prices have been higher from that 448 price for several months this year. And let's look at what's happened actually as prices have come down by $65,000 in the second half of 2022. So at the peak, $480,000 in May, average interest rate at that time, 5.33%, 90% loan to value on that median home at the average price gave us $2,391 per month. That was $204 less than it cost in June of 2006. We are now at $415,000, but interest rates have actually gone up to 6.48% at the end of December of 2022. Average interest rate for a 30-year fixed rate loan. 90% loan to value on that median house at that average rate. That took us to $2,335 per month. That means that we're actually down by $58 per month from May of 2022 to the end of the year. $58 per month. But we've fallen $65,000 on the actual sale price of that home. So very little change, even though we've dropped significantly from that high price. That's about 15% from the high that we had achieved this year. And we dropped by only $58 per month. And we're actually still $200 per month less at the end of 2022 than we were in June of 2006. Not because the price has come down by that $33,000, because interest rates are 0.5% lower at 6.48%. So interest rates have a really significant impact on affordability, more than one might suspect. And so if prices are going to continue to come down in the front quarter of 2023, which is likely, at least January, quite possibly February, prices will come down. It's not going to change the affordability number, because interest rates are likely to come down slightly on the one hand as the market adjusts to more normal difference from the 10-year Treasury index. But they're also likely to go up as the Fed funds rate continues to be pushed higher by the Federal Reserve. And so we're likely to actually see interest rates increase a little bit in the first quarter, first 4 months, 5 months of 2023, which is actually going to make the affordability challenge somewhat more difficult, even as prices come down a little bit further. So in the YouTube universe, you'll find all sorts of people who have no idea what they're talking about, who maybe claim lots of experience or knowledge, saying things that you need to really ask yourself, does it make sense? Is it true? I've seen a few videos lately where a real estate agent has been saying, don't buy anything now, wait for prices to come down further. Well, it sounds like he's protecting you, perhaps, except that he may be misforecasting as related to prices. He may be misforecasting as related to interest rates. If you're a cash buyer and you don't like what the inventory is right now, and you want to wait on the sidelines a little bit for something more interesting to appear, okay, wait on the sidelines for something more interesting to appear. It's not going to be substantially reduced in price, but if you save $5,000, $10,000, $15,000 by waiting a few months, okay, that's fine. If you're one of the 2/3 to 3/4 of buyers who buy with a mortgage, so the overwhelming majority of the market, waiting is probably likely to do nothing for you because interest rates are likely to go higher over those first several months of 2023. And so even as prices come down, it's not going to change your monthly payment substantially. It may go up a little bit, it may go down slightly. As we've seen, the payments have gone down $58 per month from May, even though prices have come down by $65,000. So it's really bad advice for people who could find what they're looking for right now if they're going to be taking out a mortgage. So everybody's position in the market is going to vary somewhat. The person who bought in May at $480,000 on that median house has lost some money. They've lost $65,000. They're still up if they had an 80% loan to value, not up. They still have equity if they had that 80% loan to value mortgage. So they're not underwater, but they've definitely not made money. If you bought at the beginning of the year, you're down a few dollars. If you bought last year, you're up from where we were in any month other than the end of 2021. You're up from where you were in 2021 when you bought. So everybody's position in the market is going to vary, and to give global advice, don't buy now, is really problematically misleading. And while it may come across as first as, oh, someone's looking out for us, the advice is so general, so not specific to your interests, your needs, and your circumstances, that it's actually really bad advice. You should be going and talking to your own real estate agent. Obviously, at the Chong Miller Group, we are real estate agents. We can help you buy and sell property. We can help investors, and we do. We can help you figure out how to maintain your wealth and grow your wealth, because that's what we do for our clients. So please reach out to us. We'd love to help you with your real estate adventures. Talk to us and find out what the specific advice is that we can give to you that matches your circumstances, your needs, and your position in the market, whether you're a buyer or a seller, whether you're buying for yourself or buying an investment property. We look forward to talking with you. Thank you.